This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, I'm Demisha Greater from Net Group Investments Multi-Management. This install of your market and economic wrap is titled, From Risk Off to Relief. How durable is this rally? Today's market update is best described as a sharp U-turn in markets, as investors reacted to a sudden easing in geopolitical tensions. But with a healthy dose of caution about how sustainable this rebound really is. Markets opened the day firmly on the back foot, still digesting escalating tensions between the US and Iran and the implications for inflation, oil prices and interest rates. However, sentiment turned decisively in the afternoon following comments from US President Donald Trump, indicating that planned strikes on Iranian energy infrastructure would be paused for 5 days to allow for talks. That shift in tone was enough to spark a relief rally across global markets. Locally, the reaction was immediate. The rand strengthened sharply, reversing earlier losses after trading as weak as 17 rand and 24 cents to the US dollar earlier in the day. At the same time, the JSE recovered strongly, climbing back above the 110,000 level after slipping close to 106,000 at its weakest point. By the close, the all-share index was modestly higher, with resource stocks once again at the center of the action. Within the market, moves were dramatic. BHP gained around 3.5%, Implats and Harmony both rose more than 2%. On the other side, Sasol, which had benefited earlier from surging oil prices, fell almost 2% by the close of the bell as crude reversed course. And that brings us to commodities, which have been a key driver of volatility. Brent crude oil fell nearly 11%, dropping back below $100 a barrel after briefly topping $112 a barrel late last week. The pullback reflects growing hopes that a broader energy supply shock may be avoided, well, at least for now. Meanwhile, precious metals moved sharply lower. Gold fell almost 10% last week, its worst weekly performance in over a decade, and is now around 25% below its late January peak. This retreat from traditional safe havens highlights how quickly markets are swinging between fear and relief as headlines change. Global equity markets echoed this pattern. US equities jumped at the open, with the Dow rising around 1.7% or roughly 800 points, while the S&P 500 and Nasdaq also moved firmly higher. This was a welcome rebound after all three indices had been flirting with correction territory following several weeks of declines. In Europe, stocks rebounded sharply as well, while Asian Pacific markets were weaker, reflecting lingering uncertainty and the region's sensitivity to energy prices and global trade dynamics. While markets clearly welcomed Monday's developments, it's important to stress that this remains a headline-driven environment. As several strategists have cautioned, markets may be responding more to the direction policymakers appear to want to take, rather than to any firm resolution of the underlying conflict. Without tangible follow-through, Monday's relief rally could prove short-lived. Looking beyond the immediate market moves, monetary policy remains a critical anchor for investors. Last week, the US Fed left interest rates unchanged as expected. However, its messaging struck a more cautious tone. The Fed highlighted that the conflict in the Middle East poses risks to both sides of its dual mandate, inflation and employment. While policymakers still see scope for a single rate cut later this year, markets have become far less convinced, with some even pricing in the risk of further tightening should inflation pressures re-emerge via higher energy costs. This has supported a resilient US dollar, which has once again reasserted itself as a safe haven. During periods of geopolitical stress, Historically, shocks that carry inflationary consequences, such as energy-driven conflicts, tend to favor the US dollar, and that dynamic appears to be playing out again. For South Africa, attention now turns squarely to the SARB's Monetary Policy Committee meeting this week. The Reserve Bank faces a delicate balancing act. Now, prior to the recent escalation, inflation expectations had been improving meaningfully. The BER's latest survey showed 5-year inflation expectations easing to a record low of 3.6% and moving closer to the SARB's preferred 3% target. However, those surveys were conducted before the surge in oil prices and the recent bout of rand weakness. The key risks now lie in how higher oil prices persists and whether rand depreciation becomes more entrenched. A temporary shock may be something the SARB can look through, keeping rates on hold, but a prolonged period of elevated fuel prices combined with a weaker currency would raise the risk of second-round inflation effects and could force a more hawkish stance to protect the credibility of the inflation target. In terms of the dollar-rand dynamic, the rand has given back some of its early year strength, with the trade-weighted rand weakening notably since geopolitical tensions escalated. While a cautious Fed may limit the upside for the dollar over time, near-term risks remain skewed towards continued volatility, particularly if global risk sentiment deteriorates again. Inflation and central bank credibility remain tightly intertwined, and markets are likely to stay volatile as investors navigate these cross-currents. We've come to the end of our note. Until next time, do take care from the Multi-Management team.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.